Hello, welcome back, guys. In this video, we're going to be taking a look at AMC Networks, a company that is super interesting right now, and it's been going down for a long time. It's down about almost 50% right now, as you'll see here. If you take a look at the 3-year chart, you will see that it's been going down. It's a downtrend story again, as many of the streaming companies right now. Now, you can take a little bit of a look at our stock news page here, and one of the news that pretty much is one of the articles that I've first spotted is this one, which is talking about streaming stocks potentially slowing down here. And the author is actually wondering whether it's a buy right now, this kind of streaming companies. Now, you will see here that the foreseeable future isn't likely to look as robust as the recent past. We do know this from Netflix. We got the fact that Netflix has been going down in terms of its streaming pretty much performance, I should say. They have lost subscribers. It doesn't look like they are in their peak right now. They're pretty much kind of slowing down for the most part. And you kind of see that here, a clear streaming slowdown. Netflix may be on the defensive here, but it's easy to chalk up its woes to company-specific circumstances. Take Walt Disney as evidence of this possibility, because this was able to garner 14.4 million net new customers here, which is a company that has still a little bit of growth to do, probably quite a lot actually. But remember, Disney is not in the same level as Netflix is. Netflix has been operating as a streaming platform for more time and has much more subscribers, so it's much tougher for it to grow is the thing. Now, you will see here for for Paramount Plus, for example, that's Para over here, that Paramount Plus and Pluto and AMC Networks, it's a handful of niche streaming platforms were also thrust into the spotlight by the COVID-19 pandemic, of course, driving significant growth even though they were launched prior to the pandemic here. And the streaming industry isn't imploding. We do know that. I mean, streaming is here to stay for a while because it's convenient for people. And we are looking at a lot of companies actually adding some ads, for example, in their operations. So they will be having some pretty much plans, streaming plans pretty much for their subscribers. That will include ads as well. They're going to be cheaper, but they're going to be including ads. So they're going to be getting some revenue from ads from people who actually opt in for this one. So it's interesting to see what's going to be happening, and of course, when we're talking about this company here, the one that we are examining, AMC Networks over here, we are seeing that this is a small company. This is a 1.1 billion, and it's a potential acquisition target as well. Now, again, it's been going down with the rest of the market, pretty much a streaming market, and so the next thing that we want to do is examine whether it makes any sense to be buying this one. And you will notice here that the PE ratio and price to free cash flow is actually tremendously nice here. It's sitting at 4 for its PE and 11 for its price to free cash flow, which is rather low and actually kinda points to a company that could be a nice purchase over here. The company has been also buying back shares like crazy, as you'll see. So they have been spending a ton of money to be buying back shares. Now, their free cash flow has been a little bit in sort of like lower territory since when compared to the previous years, and we will examine that. It hasn't been doing great, but again, there could be multiple reasons why this is happening really, and we want to be examining the financials in a little bit more detail, because this could, for example, be a one-off, for instance. Now, if you take a look at the revenue growth, it has been growing but not tremendously, and it's been going up and down a little bit. Now, in terms of net income, also kind of going down, and free cash flow again kind of going down. The net income going down is also concerning. We typically want companies to have a better net income, especially when we're looking into the pandemic. Pretty much, if you're not growing, then when are you going to grow? Although I guess this is a company that is not as, again, it's not the same thing as Netflix is, which kind of grew through the pandemic. It's much more niche here and has much less options, I suppose, for now at least. In terms of equity, they have been growing because, as you'll see here, they have been growing very nicely. And you kind of see that the outstanding shares have been going down, which means that they are spending a lot of their equity to buy back shares. So we do need to examine what was the reason behind this growth here, when pretty much all the net income and free cash flow is pointing to negative territory. So what is happening here? How do they increase their equity here? Now, you will see that the debt to equity is rather high. This is a company that has quite some debt. It used to be higher, which is nice to see it going down, but still they do have quite some debt compared to equity. Returns on equity are pretty nice here, as you'll see. The margins are fairly solid. For now, they used to be better, of course, but this is a competitive space. You're going to be looking at some suppressed margins for a while, that's for sure, and could be even for a long while. Okay, Now, this is a company that it really makes a ton of sense to be taking a look at their financial statements. Of course, every company does, but this one especially because there are some things to answer here and some questions that we need to answer. So 2.8 in revenue to 3, pretty much growing, but not much, and a little bit of a slump in 2020. In terms of net income, 400 million to 250, so it has gone down. It has gone down here, which is not a pretty sight to see. Yet it may be a potentially, better price for us because after this decline in net income, we may be getting the stock at a cheaper price, especially since the company has been buying back shares like crazy. It's getting even cheaper and cheaper actually, because now we have less stock and the valuation kind of drops in terms of its PE, for example. Now that actually happens, of course, if the company is doing well, because that matters a lot. Because when you are buying back shares, remember that you can artificially actually explode your return on equity, for example. But we do see that their PE ratio, for instance, is rather low. So it seems to be valued at a very, very low valuation, especially compared to companies like Netflix here. Now, let's take a look at its balance sheet, which is interesting. And you will see that I think that the two things that I want to see here, the total assets of the company, total liabilities of the company. You will see that the total assets are sitting at 5.7 billion over here, and the debt of the company is sitting at similar levels to where it used to be, 3.1 to 3 over here. Now, we kind of want to see here what is going on in terms of the current assets and non-current assets, how these have been growing a little bit, and they're at about similar level, a little bit more actually. So the total current assets, which is the current assets, are the assets that are basically can be liquidated in the next 12 months. They are short-term assets pretty much, are sitting at about the same level as in 2017, just a little bit more. Same thing with the non-current assets. They are sitting at about the same level. A little bit of an increase in the intangible assets here, like this could be patents, for example, things of that sort, things that are assets for the company, like trademarks and things of that sort, but they are not tangible assets, so they are the intangibles pretty much. Okay, so in terms of the total assets of the company, 5.7 billion, total liabilities 4.8 billion, and this means that we are having a total equity of 900 million here, which has been increasing through the years, is a nice thing, even though the company has been buying back shares, which means that they have been spending money to be buying back shares and still increasing their equity. This is, generally speaking, a nice sign actually for the company, because when you are spending tons of money to be buying back shares and still your equity grows, that means that you are actually making quite some nice profit here. And even though the profit has been going down, as we'll see, we saw it in the pretty much the net income that the company was generating. Remember, they were generating, if we go back here, like 250 million, for example, from 400. But remember, the company's market cap is 1 billion, so this is 1/4 of their whole market cap that they actually make every year in terms of net income. That's a lot. And so this is the reason why, even though it has been going down, we're still looking at growing equity for the company, total equity. And you will see it here in terms of the operating cash flow, for example. After the adjustments, there are some changes in working capital. Now, working capital means that the company is actually spending some money for its current for its current liabilities, pretty much, because working capital is basically just telling you what is the liquidity of the company, because it's current assets minus current liabilities. And when you are looking at a negative number here, it means that the company actually spent some of its cash reserves in order to have some current liabilities, for example, or for instance, they may have bought something, and this is not a current asset, for instance, but it's actually a long-term asset, and so you are spending some money there. So things of that sort. Now, you have to distinct, and I have talked about it, the fact that, for instance, if you're buying inventory, this is a separate entry because it is not working capital. It is a current asset, pretty much. But the thing is, it doesn't affect the working capital, because when you are spending money to buy inventory, you're actually spending a current asset, which is cash or cash equivalents, in order to buy a current asset, which is inventory. So you're basically balancing it out. So it's basically zeroed out. But if you're, for example, getting a long-term debt in order to buy, let's just say, something that you're going to be using for the next 12 months, now you're having a current asset, but then you are not having a current liability, because this is a long-term liability. It's a non-current liability because you're getting debt, for instance. So there are a lot of things that are going on with the change in working capital, but we are looking at a company that is pretty much having a similar amount of cash being burnt in working capital here every year. And of course, you can examine the finer details, but it's important to see how this money gets extracted from what is happening in their operations. And it's pretty much the same story every year, pretty much. So you can kind of course, you want to examine exactly what this is, but you can kind of see that there is nothing out of the ordinary here for the company's financials. And again, remember that this is a company that has a ton of costs for producing stuff, for instance, because they have to stay up to date. So they have to be producing lots of shows and things of that sort in order to remain pretty much relative to the industry and actually be still not become obsolete. So that's important to keep spending. Now, you will see that the free cash flow is still positive. It's worse than what it used to be, and that's something to take care of and be mindful about. But it's still positive, and again, you're looking at a bad year over here, which you can examine in a little bit more detail, and you will see that's again because the net cash from operating activities was low. And you will see here that the net income is about the same. So it's not the net income that caused this. And if you dig a little bit deeper, you'll see that it's the change in working capital which caused this. Which, generally speaking, again, it's something that the board controls, the operation, the business controls pretty much. And of course, you can see the finer details in the 10K, for example, or the 10Q. You can use our tool here, of course, and pretty much jump to the SEC filings. And you can actually read whatever filing you want here using our tool to discover all the finer details. But it doesn't seem like there's anything out of the ordinary here. Now I'm going to use our stock evaluation tool to discover what is going on with the stock price. Is it a buy? And the company has been growing overall, not much, but at 2%. So I'm going to go low. I'm going to go 1, 2, and 3 here, somewhere in between. And the net income margins of the companies have been sitting at 12% on average. Now, I'm going to go a little bit lower. I'm going to go 8, 10, and 12, just to see what happens. And the free cash flow, that is about, for the most part, near 100%. Of course, there's going to be the odd years, but I'm going to be using the typical one, 80, 90, and 100, which makes a ton of sense. It's basically 80% of this value, 90% of this, and 100% of this. This would be 12% in terms if you actually compare the free cash flow to revenue. Because the reason why we're doing this in terms of a percentage is because we need to correlate our free cash flow to the profitability of the company, that is the net income. And that's the reason why we're doing it this way. So 13% for an annual return, and what we're getting out of this. As you would expect, this is a very, very cheap company based on its free cash flow, based on the amount of money it generates. And of course, there are some issues with competition. There is the fact that streaming is, many more streaming companies get introduced. But, if you're getting something for cheap, it may be a potentially interesting addition to a portfolio here. And one of the facts that I also like about this company is the fact that they are not paying any dividends, so they are not actually pretty much burning any of their cash flow, which they can use to increase their operations, to make their operations better. Pretty much get better shows, compete with the industry. I wouldn't like them to be paying any dividends here. So again, a very, very competitive industry, looking like a company that is pretty cheap though, so I would definitely be considering this one for a portfolio, no doubt about this. Now, I will be adding, of course, this company here in our sheet, in which you can find all the companies that I have been talking about in the videos that I'm making for the channel that are worth taking a look at. And this is like a small diary that's all our patrons have access to. So remember to visit this and find a summary of what I'm discussing in the videos. But if you are not a patron, remember that you can become one by visiting this link, or basically just clicking on the description box below this video. And remember to like and subscribe if you're not a subscriber already, and I'll see you in the next one. In the meantime, take a look at the video that I made earlier about Vinco Ventures, or BIG as the symbol is. An interesting target that will strive to be a TikTok competitor. We'll see about that, but it's a very interesting video to watch, I'm pretty sure. And I'll see you in the next one. Bye bye.